Now let's go to step 6. In terms of step 6, we are going to calculate the profit or loss on the futures contract and the net interest cost using the future hedge. Okay, so let's calculate the profit or loss. We entered this contract by selling the March contract, and as we sold it, the March price at settlement date is 93.88. So whether interest rate is supposed to increase or decrease, our selling price of the March contract will be 93.88. Now, when we saw interest rate increasing by 100 basis points from the previous two slides, we saw that if interest rate increases by 100 basis points, the closing future price is going to be 92.96, and when the basis or the LIBOR decreases, the interest rate is going to be, or the closing future rate is going to be 94.96. Okay, so if you entered by selling at 93.88, and if LIBOR increases by 100 basis points and the price of the future closing price is 92.96, whatever you did to enter, you will have to do the opposite to close it. Therefore, if you entered by selling, we would have to close it by buying. So we will buy at the future rate of 92.96 in terms of interest rate increasing and 94.96 in terms of interest rate decreasing. Okay, so for each contract that we entered into, we will make a profit of 0.92 if interest rate increases, and obviously we will make a loss when interest rate decreases, and that is what we got as 1.08. Now, if you want to bring it in terms of ticks, then you obviously have to multiply by 100 in order to multiply by the tick size. So if you multiply the 0.92 and 1.08 by 100, you will get 92 and then 108. You get 92 and then the 108. The tick size was given in the question as 12.5. So you just multiply the 92, the profit or loss, in terms of ticks by the tick size of 12.5, and that will give you the profit or loss per contract that you entered into. Per contract that you entered into, and we calculated a number of contracts to be 80 contracts. We calculated a number of contracts to be 80. Therefore, if you multiply the 92 by the 12.5 by the 80 contract, it should give you a total of 92,000. And that of the loss when interest rate decreases is going to be a loss of 108 times the tick size times the number of contract, and that is giving the 108,000 as well. The 108,000 as well. So this gives us the profit or loss on the futures contract. What will be the overall outcome? Which in some terminologies, some will say net interest cost using the futures contract. Okay, the futures contract will be done in the derivative market, and we would have to go to the bank or elsewhere to go and borrow. So where we're going to borrow is what we're referring to as the market. So the market interest cost. If we are going to borrow, we borrow at the LIBOR plus 50 basis points. If we expect the LIBOR to increase, then if the current LIBOR is 6% and LIBOR is increasing by 1%, then we have to borrow at 7%. If LIBOR is expected to decrease by 100 basis points, we expect the LIBOR to be 6 minus 1, which is going to be the 5%. However, our spread We borrow at LIBOR plus the basis point, which is the spread. Our spread is 50 basis point, which is the same as 0.5%. So it means in the cash market, if we are borrowing, we will borrow at an interest rate of 7.5% if interest rate increases, or 5.5% if interest rate decreases. Okay, how much are we going to pay? How much are we going to pay? We need to borrow 30 million at an interest rate of 7.5%. If interest rate increases, we are borrowing for a period of 4 months. We are borrowing for a period of 4 months. So once we are borrowing for a period of 4 months, we need to express it over a 4 months period. We need to express it over a 4 months period. So 7.5 times 4 by 12, or multiply by 30 if interest rate should increase by 100 basis points. Then 5.5 by 4 divided by 12 times 30 million if interest rate were supposed to decrease by 1%. Okay. Now, if I have to pay 750 in the cash market when interest rate increases, as a result of entering into the futures market, I have been able to make a profit of £92,000. So, paying the 750, I will use the £92,000 that I made as a profit in the future market to reduce my interest payment. So if I've made 92,000, then I will have to deduct the profit of 92 from the 750 that I paid. So the net interest cost to me is going to be the 658. 658. I do the same thing for if it decreases by 100 basis point. So 550,000 as the cost, but I made a loss of 108. So I will have to pay additional loss of 108. So the total figure is 658. And whatever the case is, whether interest rate is going to increase or interest rate is going to decrease, you would have to get the same net interest cost so far as the futures hedging is concerned. So effectively, your interest rate that you would have to pay will be the 658 divided by the 30 million multiplied by 12 over 4. And that gives a 6.58% effectively. So this is how you can use the futures market as a way of hedging your interest rate. Your first responsibility is to look at what date contract, and what date contract should be the contract that matures immediately after the transaction date or the date of borrowing or investing. Then do you have to sell or do you have to buy? As long as you're going to borrow, there's the need for you to think of what selling. And whatever you do to enter, you have to do the opposite to close it. So if you entered by selling, you close it by buying. Then you calculate your number of contracts. How many number of contracts you're supposed to enter, because features are entered in a standardized word amount and in specified number of contracts. You cannot enter into features on fractional basis. Okay? And when you are calculating the number of contracts, there will be the need for you to remember that there might be a maturity mismatch. If you are not borrowing for a period of 3 months, but you're borrowing for a period other than 3 months, there's the need for you to apportion it relative to the number of months you are borrowing divided by the contract period of 3 months, 3-month cycle. And you would have to calculate the closing price for the futures. There is the need for you to think about calculating the basis, spread the basis over the period. In most cases, you have to spread it equally over the months left. And then when you get the basis, you use it to calculate the closing price, and you calculate the profit or loss, and eventually you get your overall outcome or net interest cost. So that is the step 6.